Ladies and gentlemen, good day and welcome to the Q2 FY24 earnings conference call of BMW Industries. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference has been recorded. I now hand the conference over to Mr. Miraj Shah from Arihant Capital. Thank you, and over to you, sir.
Thank you, Jacob. Hello and good afternoon, everyone, and welcome to the maiden conference call of BMW Industries for the Q2 FY24 results. Today, from the management, we have Mr. Harsh Bansal, the Managing Director, Mr. Abhishek Agarwal, the CFO, and Mr. Sanjeev Sancheti, Investor Relations from Urtus Advisors. So, without further ado, I'd like to hand over the call to Mr. Sanjeev, sir. Over to you, sir.
Thank you, Miraj. Good afternoon to all the participants. It is my pleasure to introduce to all of you the senior management team of BMW Industries Limited today to present the call. With me are Mr. Harsh Bansal, Managing Director, and Mr. Abhishek Agarwal, Chief Financial Officer. Before I hand over the call to Mr. Harsh Bansal for the opening remarks, I would like to draw your attention to the safe harbor statement, which is a part of the uploaded earnings presentation. Please have a good look at it. And over to you, Mr. Bansal.
Thank you, sir. Good evening and a warm welcome to all of you to BMW Industries Limited's Q2 FY24 earnings call. I am Harsh Bansal and I wish all of you a very happy Diwali. Thank you for sparing your time to be here today. In what follows now, I will guide you through the key business and operating highlights of the past quarter, while our CFO, Mr. Abhishek Agarwal, will share the financial performance metrics. We are happy to announce an interim dividend of rupees 0.22 per share, that's 22 paisa per share. Before we get into the business and operational highlights, let me provide you with a brief overview of our company. BMW Industries Limited specializes in adding value to semi-finished steel products, a strategic approach that ensures our ability to maintain stable profit margins and offers a safeguard against the volatility of steel market cycles. This approach allows us to sustain a reliable cash flow by mitigating the impacts of demand and pricing fluctuations. Our track record of sustainable partnerships and long-term contracts is underscored by our financial stability. A testament to this is our enduring association of over 30 years with Tata Steel Limited. Our USP derives from providing comprehensive suite of services to our customers covering every aspect of the value chain, from manufacturing to logistics support. A key driver of our success is our advantageous geographical proximity to our clients. In addition, the company has strategically assembled a fleet of long-haul trailers, further enhancing our capability to deliver end-to-end solutions to our customers. In the quarter gone by, our operating revenues stood at 15,942 lakhs, an increase of 6.5% year-on-year. This increase was on account of increase in revenue from pipes and tubes division and the CRM complex that we operate. The company's gross profit margin reached 63.5%, reflecting a year-on-year increase of 259 basis points, albeit with a decline of 154 basis points compared to the first quarter of FY24. This reduction can be attributed to a change in the product mix in the quarter gone by. However, on absolute gross profit has remained stable as compared to the sequential quarter. For the future growth strategies, the company has established a clear trajectory for implementing its growth plans. First, we have planned an expansion in pipes and tubes over the next 2 years due to the high demand potential in the sector. In the phase 1, of the expansion, which is already underway. Will be operationalized by March 2024, increasing our capacity from the existing 204,000 metric tons to close to 534,000 metric tons. While in the second phase, which should get operational by end of FY25, this capacity will be increased to a little over 1 million metric tons per annum. More details on the same will be shared by Abhishek. The agreement for the conversion of GPGC sheets through the CRM complex is due for renewal by April 2024. This renewal is anticipated to yield about rupees 2,000 crores in revenue over a span of the following 5 years, with an annual revenue projection of at least 350 crores per year. Number 3, an agreement encompassing the production of TNT rebars, scheduled to continue until November 2025, is anticipated to generate revenues of close to 250 crores over the contract period. Number 4, our strategy for establishing our own brand involves several key steps, including adopting an asset-light model, developing a robust distribution network, expanding our presence in underserviced areas, building in-house logistics capabilities, and actively working on strengthening our brand value. Our commitment to safety and sustainability remains a top priority, which includes a clear focus on reducing our carbon footprint and promoting responsible manufacturing processes. To support these efforts, the company is exploring setting up rooftop solar at various plant locations. The first project has already been awarded and should be commissioned over the next 3 quarters. More details on this will be shared by Abhishek. Our unwavering commitment is on achieving consistent growth and optimizing our capital utilization, as evidenced by our recent financial performance. Additionally, we are dedicated to improving our conversion business by tapping into potential of our existing facilities where available and setting up new plants if needed. As we proactively explore growth opportunities, including potential brownfield expansions in response to the changing market dynamics, we are diligently striving to establish a unique brand identity. This strategic endeavor positions us to capitalize on upcoming opportunities in the B2C sector and solidify our standing as a comprehensive solutions provider for the Indian markets. Now I would like to hand over to Abhishek Agarwal, our CFO, to provide updates on financial numbers. Thank you so much. Abhishek, over to you.
Thank you, sir. Wishing you all a very good evening. We greatly appreciate your presence on the BMWIL earnings calls for the second quarter FY24. Before we proceed to the QA session, I will provide you with a concise overview of the financial figures for second quarter FY24. During Q2 FY24, company's operating revenue grew by 6.5% from rupees 149.65 lakhs to rupees 159.42 lakhs. Our gross profit also grew by 11.1% Y-on-Y and stood at rupees 101.25 lakhs. Operating EBITDA grew by 17.7% Y-on-Y from rupees 3309 lakhs in Q2 FY23 to rupees 3895 lakhs in Q2 FY24. While the operating margin expanded by 232 basis points from 22.1% as in Q2 FY23 to 24.4% in Q2 FY24. Notably, there is an increase in operating EBITDA margins in both Y-on-Y and Q-on-Q, despite a decrease in GP margins in Q-on-Q, mainly due to the change in the product mix for the quarter. PAT for the quarter grew by 43.6% to 17,167 lakhs as compared to rupees 1230 lakhs in Q2 FY23. PAT margin improved by 281 basis points to 11% in Q2 FY24 as compared to 8.2% as in Q2 FY23. ROE for the September 23 stood at 10.7% as compared to 7.4% in September 22, while ROC stood at 13% as compared to 9.3% in the corresponding quarter for the previous year. Our net cash from operations by operating EBITDA are healthy at 1.46 for September 23. We have been able to deploy the capital judicially, which resulted in improving the fixed assets turnover from 0.76 in FY21 to 1.28 in FY23. Net debt stood at 18103 lakhs in September 23 as compared to 24758 in September 22 and 22998 lakhs in March 23 respectively. With the reduction in debt, our net debt by equity stood at 0.28 on September 23 and net debt by operating EBITDA stood at 1.20 as on September 23. Cash conversion cycle also decreased from 228 days in September 22 to 188 days in September 23 as the company was able to utilize old inventory. Our Managing Director, Mr. Harsh Bansal, has already touched upon the pipes and tubes expansion plan. The first phase will involve an outlay of approximately 70 crores, which will be financed by 50% debt and 50% internal accruals. We have already spent approximately 50 crores for phase 1 expansion, with around rupees 21 crores sourced from debt and the remaining from the internal accruals. The second phase, scheduled to commence in FY25, will require an outlay of approximately 100 crores, with rupees 50 crores funded through debt and balance from internal accruals. The company has further outlined plans to establish rooftop solar project as mentioned by our Managing Director, Mr. Harsh Bansal. The total project cost is estimated to be approximately 21 crores and is expected to be commissioned within 3 years. As stated, is commissioned in 3 quarters. As stated by our Managing Director, Mr. Bansal, we have paid our dividend payout for is 15% of the profit up to September 23, which amounts to rupees 22 paisa per share. The company, as we progress on our growth plans, we will come back to you within the next quarter with a firm guidance on the key financial metrics. We will continue to remain focused on our long-term goal of sustainable growth and profitability. With this, I leave the floor open for Q&A and hand over the call to Mr. Miraj Shah. Thanking you.
Yeah, thank you, sir. Jacob, we can...
Yes. We will now begin.
Please.
Yes.
Yeah, we can start the Q&A.
Sure. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ranjan Mehta from AMS Investments. Please go ahead.
Hello, sir. Good evening to everyone. I have a few questions. The first question is regarding the relationship with Tata Steel on the GPGC conversion and how do we go about it here? What is the entire capacity tied up for Tata Steel, or do we also do some of the sales ourselves? What is the nature of the relationship and what is the capacity tied up, etc.? If you could throw some light here.
Ranjan, I'm sorry, but you're coming very garbled. If you're on a headset or something, can you Can you just pick up the phone and speak because we're not able to understand?
Let me just take it. I think Ranjan's question was regarding our relationship with Tata Steel, and if the entire capacity is contracted to them on an exclusive basis, or if we also work with others. Ranjan, I just want to confirm that the entire capacity is exclusively contracted to Tata Steel. We've already been doing this for the last 10 years and looking at renewing again for the next 5 years by April 2024. Does that answer your question, Ranjan?
Understood, sir. So broadly, if you could throw some light on what is the kind of spread we make on this product line?
Right. I think the gross profit itself, since almost 90% plus is what we do for Tata Steel, gross profit should be a fair indication of what kind of
we don't want
processing.
To get into individual.
Yeah, and obviously we can't get into a very detailed individual because this is a bit of a confidential information with Tata Steel which we are not supposed to share. But the gross profit, we have a very strong 64% gross profit, and that's an indication of what kind of processing income that we make.
Understood. Sir, do we also have any other opportunity to engage with Tata Steel in the Odisha Kalinganagar facility over there? And I think that CRM mill is still under works. And is there any opportunity there?
Yeah. So going forward, these are opportunities and discussions which are happening all the time. And of course, we are not the only ones. They are having this with a bunch of other people. And as and when we think there is something which works out for Tata Steel as well as us, we'll be looking to grow in Odisha.
Understood. So apart from the GPGC, did we also convert some of the TMT bars for them? Is it? And the entire, could you throw some light on the TMT business?
So other than the GPGC, we are in conversion of TMT bars as well as pipes and tubes galvanizing for Tata Steel.
Okay. And how much of external sales do we have for the TMT? There is a branded product that we were discussing in the beginning.
That's still a very small number. It's a part of the miscellaneous numbers, but yeah.
Okay. So the upcoming capacities on the TMT side over the next couple of years, as you have said. So we plan to increase.
Not for the moment. We don't have any planned capacity increase in TMT.
Oh, okay. I see. So large part of it is dedicated to Tata Steel. Understood. Thanks, sir. Thanks for the opportunity, and that's it from my side.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Chirag Singhal from First Water Fund. Please go ahead.
Yeah, thanks for the opportunity. I first of all wanted to understand on the EBITDA front. So I see that we are purely a converter, wherein we buy the steel and then we're converting or billets, and we're converting into finished grade steel or pipes or tubes. So generally, in this kind of business, what kind of EBITDA per ton is sustainable?
So I think, thank you so much for being here, Chirag. I think our numbers are at a fairly sustainable number. And as volumes increase and as, we get the advantage of scale, these are numbers which are, just to answer your question, these are very, very sustainable numbers. These are not extraordinary.
So could you help me with the EBITDA per ton number? The EBITDA per ton number on a blended basis that you see is sustainable going forward?
So I think, I think we mentioned to the answer before you, we don't want to get into a per ton numbers for vertical basis because, of course, these are very, very different products, different contracts, different numbers. We cannot disclose individual per ton numbers.
Okay. And secondly, just wanted to understand that what competitive advantage do we have over the players who are fully integrated? Because as I can see, I don't think that we have some sort of let's say a technical partnership or a collaboration with any international company that led. So one of the listed company has a similar model wherein they are pure converters, but they have a technical collaboration, and they are the exclusive suppliers as well to the same company, international company. So over here, I don't think we have such kind of collaboration. Just wanted to understand on the competitive advantage that you feel you have over the players who are fully integrated.
So number one, Chirag, we don't make steel, so there is no question of comparing with an integrated player. And in terms of foreign partnerships and technical tie-ups, at this point, we don't see any processes where we need such a tie-up. As and when time goes, and if there is a need, we'll definitely look at someone. In terms of competitive advantage, I think we've been doing this business for almost close to 40 odd years. And we understand the market well, we understand our processes well, we'd like to believe we have a fair understanding of what our customer wants and what our customer want. So, I think that's our competitive advantage.
Okay, and could you help me with the what is the who are the main industries which consumes these pipes and tubes? So does this go in the oil and gas and water supply and all?
Chirag, as far as my customer is concerned, that's Tata Steel. And I guess, a lot of the products are now getting into construction, infrastructure. As you know that a lot of the retail waterworks may have converted to PVC, but there is an entire growth in the infrastructure and construction market, which now the steel pipes are serving. In terms of detailed industry breakup, I won't be able to give you that because we really don't, we're not at liberty to disclose who my customer are.
Right. Okay. Got it, sir. Okay. Thank you. Thank you so much.
Thank you so much. Thank you, sir.
Thank you. The next question is from the line of KD Mishra from NJ Advisory Services. Please go ahead.
Thank you, sir. Thank you for the opportunity. So I wanted to understand a little more about the Tata Steel relation that you have. So in the TMT capacity, you have 3 lakh tons of capacity and you are exclusively supplying to Tata Steel as your customer. So why is the production then, it's FY23, it was 1,22,000. I mean, could you not increase it because you are anyway going to supply them exclusively?
So, great question, Mr. Ji. I think the challenge over here is that we can only supply to them based on what billets they give to me to convert. Since I don't manufacture the billets and we can't buy billets and supply to them, as and when they give me the billets for conversion, we convert it and give it back to them or within their supply chain. In terms of FY23, I think their procurement or their purchase of Neelachal only started ramping up during this FY. So, you'll see most of the volumes coming in this FY. Last FY, where the billets were coming purely from Jamshedpur, there was a constraint on billet supply.
Okay, understood. And the pipes and tubes capacity that you have given the capex layout here of a 1 million ton. So that is also entirely exclusively contracted with Tata Steel, as I understand.
Yes.
Okay. So and sir, other thing is that you are making a healthy amount of cash profit. So in your next capex, so how is it going to be if the prices of the steel and the pipes and tubes, which is since very high after the COVID times, so what kind of a margin that you get from Tata Steel, if you can disclose anything around that?
So first of all, thank you for complimenting on the healthy margins. Always good to hear that. But I don't think we are at liberty to disclose specific contract margins. And going forward, I think Abhishek spoke about the capital structure, basically a split between debt and equity internal accruals that we'll be using. And going forward, as the capacity comes online, it's very difficult to predict that today.
So, but just to give you a sense that we are already doing a gross profit margin of 32 to 35%, 62 to 65%, and an EBITDA margin which is close to 25%. With scale going up, with the new pipes and tubes capacity coming up, I'm sure this is going to go northward. So, I mean, we seem to be in a good spot here as the volume grows.
And I think somebody else also asked this question, just to reiterate that, I think our numbers are on a sustainable basis. So, the numbers that we have on the balance sheet, the advantage that we'll get with scale and all notwithstanding, the current EBITDA and gross profit numbers are fairly sustainable.
Okay. So, I mean, what I want to understand is that if your margins are improving, so going ahead, I mean, is there any chance that you have in your contract, any clause that by which you can extract some more profit from your exclusive customer, increase your pricing power there?
This works both ways, yeah. As a buyer-seller relationship, there will always be this tug of war between the buyer and the seller. So, if there are certain secret strategies to extract more, I'd love to learn more about them. But I don't know.
Also, that we must keep in mind that when you deal with pedigree customers, just because you are a large portion of their scheme of things, you can't start ceasing them. Yes, of course, you will, through efficiency, through scale, you will make more money, but you can't kind of,
But it has to be sustainable.
Sustainable, and it has to be win-win. So as long as it is win-win, yes, we'll all love to increase our margin.
Okay. And one last question, sir.
Mr. Mishra, may we request you come back to the question queue for any follow-up question?
I'll get back in.
Thank you. The next question is from the line of Rakesh Agarwal from United Infracore Limited. Please go ahead.
Hello, am I audible?
Yes, sir.
Yes, please. Yes, Rakesh.
Yeah. Good evening, sir. I'm from United Infracore. I've got two specific questions, sir. One is, I was very heartening to know about all the margins and all, but Bansal Super, the brand that you're going to launch or you have launched on TMT bar, rebar space, how will you manage on the competitive basis with Tata Steel, because they have their own established brand, Tata Tiscon?
So great. So that's one question. And the second one?
And the second one is that you have spoken about based on slide number 25, which Mishra ji asked about your capacity utilization on 3 lakh ton 122, you're projecting 170, then 225, and you spoke about the shortage of billets, which is not coming for you to utilize your capacity full. And you're expecting billets will come from Vizag. Will it not hamper the cost structure, or you're planning to, in future, to set up similar facilities in and around the Vizag plant?
No, so let me take your second question
because your USP lies in being proximity to the plant, which is 5 kilometer radius. And in case the billets travel so long, I really wonder how the cost structure will work out.
Perfect. So let me take your second question first. We have absolutely no intention of getting billets from Vizag. I had mentioned NINL and not RINL. NINL is an acquisition that Tata Steel made sometime last year in Odisha, from where we are currently receiving billets in our Calcutta plant. And the Calcutta plant also receives billets from Jamshedpur. The billet supply issue which was happening up to last year is fairly sorted out right now, and we are getting billets from Tata Steel on a much more consistent basis. So that talks about, that kind of justifies, and that's what we are looking at in terms of the increased utilization of the TMT capacity going forward. Coming to your first question about Bansal Super and the competitive advantages and etc. So, anytime you want to create your own brand and you want to create your own distribution, it's a long-drawn process. I don't think we are, we are not looking at burning a whole lot of cash and jumping majorly into the market. We want a slow and steady sustainable growth, which we will continue to do. In terms of market competitiveness, we are serving a completely different market as compared to Tata Tiscon. We are essentially in rural, underserved areas, and that's a part of our strategy. We are supplying a lot of the smaller, order lots, etc., which is a part of our strategy compared to Tata Tiscon. So they're two completely separate. Tata Tiscon is a high-end branded product. Bansal Super is a much more market-based, low, not really low, but a standard market product. We don't make our own steel, so we have to use other innovative ways to get through to the customer.
Yeah. So just to complete this, sir, are you planning to put up a capacity in and around the Odisha facility to facilitate the customer service better and reduce cost for Tata Steel?
This was, as mentioned earlier, these are the plans which are always under discussion with the customer, and as and when the customer feels there is a project which we can add value to and we think it's worth our while, we'll surely be looking to do that. We are also in talks with the government of Odisha for various other facilities that they offer, and as and when things come together, we'll look at it. As of now, at least up to FY25, I do not see major capex happening over there.
Thank you so much, sir. I grew up seeing your plant coming up in Ramdas Oil Mill, Manusik. So I've got very fond memories of that. Thank you very much, sir.
Thank you so much.
Thank you. A reminder to all participants, to ask a question, you may press star and 1. The next question is from the line of Surya Narayan from Sunidhi Securities. Please go ahead.
Yeah. Good afternoon, sir. This is, am I audible, sir?
Yes.
A little, it's not so clear, but you are audible.
Okay. Thank you for giving me opportunity and congratulations for the good set of numbers. So just to understand our relationship with the Tata Steel, so how often we negotiate the rates with the Tatas, and is it different for the CRM mills and for the rolling mills or let's say long products at Calcutta? So if you can throw some light on first question.
Sure. So thank you so much for being here and asking the question. I think so. Over a period of time, there are all different contracts for different products and sometimes even different plants. These contracts can be anywhere from 2 years to 5 years. They are typically minimum 2 to 3 years and maximum 5 years. So that's generally the tenure of the contracting.
Okay. So if that is the case, then is the contracts taking into account the cost of inflation of the inputs, be it labor or power? So what actually it is taking into consideration? Whether the slow motor increment happens from the Tata Steel in relation to the power at least?
So different contracts are built differently. Like I mentioned, we can't get into the details of the contracting, but we do try to cover for very, very sensitive factors that affect our costing.
Okay. So another question is that what I have understood from your operations of the last year, that the new trigger that has come up is due to the Neelachal, Tata's taking over the Neelachal and the expansion, or let's say greenfield project at the Kalinganagar. So with that relationship, what I understood is that with the Jamshedpur facility of Tata around 12 million tons, we are able to get an opportunity of nearly 1.2 million tons, or around 10% of the output of the Tata. So with nearly about roughly Tata, as you know, is ramping up their capacity. So how much capacity Tata will be expanding in over a horizon of let's say 26, and what kind of output we can expect?
So I'm not the right person to comment on Tata's expansion plans, but I think we have fairly clearly mentioned about our plans up to FY25. And when you look at 1.2 million tons that we may be doing, it's not all coming from Jamshedpur. So I don't think it will be fair to say that we are kind of processing 10% of Jamshedpur's output. A lot of our products come from Kalinganagar. A lot of our raw material comes from Kalinganagar or NINL. And so, there is it's completely mixed. So when you look at Tata's capacity in all and my capacity in all, you can draw a conclusion, but I don't think it's fair to say that we are processing 10% of Jamshedpur. And I think a certain amount of my capacity will also be, I'm also processing some other, for example, Bansal Super and others. That's all reflected in the 1.2 million tons.
Because up till 26 Tata's export Tata's fitted plants, they would be adding 13 million, so close to 13.7 million tons, and up to 2030 it is 27 million tons. So is it a kind of expansion that we can think of in Odisha, because there is a dated MOU by the Odisha government that they have given you or allocated you some kind of land for a project costing around 900 crores.
So that is I know what you're talking about. This was a MOU that we had done some time back. We do not have land allotment on that because we were not, the discussions with Tata were not conclusive. However, going forward, we are optimistic that with Tata's capacity expansion, there will be enough opportunities for us in various verticals.
Okay. And so another strategic question is that whether Tata's agreement, binding agreement, hinders you to enter into any areas outside of the eastern part, because you have sufficient understanding of pipe making or let's say pickling, all the kind of steel processing. So why that kind of knowledge cannot be replicated elsewhere rather than limit yourself to only eastern part or let's say concentrated to Tata's? So that was my question.
So I think that's a strategic decision that the company makes, and thank you for the confidence that we can do it in other places. We are a little more conservative, and I think as opportunities come, we'll continue to explore whatever is possible for us, but on a conservative basis. We don't want to be too aggressive and step too far out of our comfort zone. A little bit is okay, but not too much. So for the time being, I think it's Eastern India, and maybe in the future, who knows?
Okay. So with the inclusion of the pipes, to 1 million tons. So how we are seeing the expansion in the margin, happening, maybe for the current around 25-26%. So can we expect around close to 30% for the terminal year of 26?
I think we will come back with the proper guidance in the next quarter. I think it's good to wait till that time.
Okay, sir. Thank you.
Thank you. The next question is from the line of Jignesh from Jiva Capital. Please go ahead.
Yeah, am I audible?
Oh, yes.
Yeah.
Please go ahead.
Thank you for giving me an opportunity. So, I just wanted to understand, I've seen your financials. There has been a lot of debt repayment over the last few years. So, going ahead, our focus will be majorly prepaying of our long-term debt in next 2 to 3 years, or it will continue at 0.3 to 0.4% going ahead?
Hello?
Yes.
Going forward, as you can see in our this quarter also, we have repaid the debt, and our debt by equity is getting down compared to every quarter it is improving, and going forward, we will be utilizing our free cash flows in repayments of debt, and as stated for the expansion, partly will be from debt, from internal accruals, but at the gross level, the debt will reduce, and our net debt by equity will improve.
Just to reiterate that our focus continues to be a very judicious deployment of our free cash flows. A good part of it will go to repair the long-term debt that we are presently having. while you would have seen in the presentation that we have said that we are going to use debt for the new project, but please understand that that's because we get for new projects very fine rates, but on a net basis, our net debt will continue to go down in spite of the expansions.
It's almost 50 crores down.
So just to give you a sense that for the current expansion, where we have already stated that we are increasing capacity to 534, we have already deployed 50 crores, right?
Out of which
in spite of that, our net debt has gone down.
Gone down by 50 crores.
Okay.
Right? Does that answer your question?
Yes, sir. So, then one more question. There is one slide related to the manufacturing value chain. So,
Manufacturing value chain, okay.
Yeah. So, in that, whatever presence that we have, I just wanted to understand what do logistics cost form part of our part, or it is done by Tatas themselves, giving us the billets and taking the finished goods?
So it's a service that we offer in addition, and we would love that Tata uses more and more, or our customer uses more and more. However, if they wish to do it themselves, we are good with that. Like any other service, it's an optional service that we offer, which the customers can pay for and use.
Okay. Understood. Thank you.
Thank you so much.
Thank you. The next question is from the line of Shubham Chopra from Jainam Broking. Please go ahead.
Am I audible?
Yes, Mr.
Yes, Shubham.
So my first question is, what would be the return on capital employed that you are expecting for your capex?
I don't think going forward it will be below our existing levels, and this is something that we'll try to maintain and improve going forward, definitely.
So can't you mention any margin, percentage margins?
So we believe that on an IRR basis, our projects will be upwards of 17 to 18%.
All right. So will operating leverage play out in your business too?
Yes, it will. Definitely it will.
All right. And this pipes and tubes capacity will be sold through B2C channel, or it is also towards Tata Steel?
So it's as of now, it's completely for Tata Steel.
So just to explain you that this is largely a brownfield expansion. So it has multiple benefits. It entails operating leverage because of scale, but also that it's a brownfield. You get a better, your cost of expansion is much lower, and hence your IRRs are better because the base infrastructure is already ready.
Okay. So when are sales expected to go live? Means after capacity installation? Means within a month or 2 or a quarter?
So we've, this was a part of the briefing. We expect some of the capacities, they are moving on a phase-wise manner. We expect some of the capacities to go up by FY24 and by FY25 further.
So just to specifically tell you that our present expansion from 3.4 lakhs to 5.3 lakhs, that's going to be commissioned by end of this financial year, which means that from the first month of FY24-25, the capacity will be in place, and the 10 plus million from a 5.3 plus million situation, that will be commissioned by the end of FY25, which means in the first month of FY26, the capacity will be up and running.
Okay.
Does that answer my question?
Yes. Thank you. Happy Diwali in advance.
Happy Diwali to you as well. And your family.
Okay. Thank you.
Thank you. The next question is from the line of Miraj Shah from Aryan Capital. Please go ahead.
Yes, Miraj.
Yeah, thank you for the opportunity, sir. Just had one question I wanted to understand. If in case we want to increase the capacity out of the contract that we have with Tata Steel, can we do that?
Come again, Miraj, I didn't get you. If we want to do what?
Increase the capacity for production. Right now, all our entire capacity is exclusive for Tata Steel. So as you mentioned in the start that we are coming out with our own brand as well. I wanted to understand that if we wanted to increase our capacity either for Tata Steel or apart from the contracts with Tata Steel, can we do that? Is that possible?
Yeah, of course we can increase the capacity. There is no, so while the capacities we create for Tata Steel are exclusive to Tata Steel, the business, there is no compulsion on us in the sense that there is no non-compete, if that's what you're asking.
So what he's asking is that can you use the same setup and add capacity and sell it outside, is what he's trying to say.
Yeah, I think that's okay.
That's okay.
So do we have plans to do that? Wouldn't that, significantly help us scale up? Scale up from here in a significant manner.
So Miraj, I think theoretically what you're saying is absolutely right. However, that would also bring with it a whole bunch of risks that I don't think we would like to address right now. So, the plans that we have right now going forward, I think they're fairly covered by Tata Steel, and we don't see the need to step outside of that.
Understood. And so the rooftop part also, which you said is for 21 crores, which you're going to spend in capex and which is going to be commissioned in 3 quarters. That is also for Tata Steel only, right?
No, that is for our own plants. Because in West Bengal there's a fairly high cost of power. So this is, we just want to use rooftop solar to kind of average out our cost of power.
Understood. Okay. Thank you.
Thank you, Raj.
Thank you. A reminder to all participants to ask a question, you may press star and 1. The next question is from the line of Swati from GS Advisors. Please go ahead.
Thank you for giving me the opportunity. I wanted to ask, can you explain the steps you plan to take with the new B2C foray you have made for branding and for scaling up this particular brand?
Sorry, you weren't very clear. Can you please repeat it once?
Sure. This new Bansal brand that you had mentioned, the new foray that you're taking, can you explain the steps for branding and, strategically how you plan to grow this?
So, like I mentioned, this is a very slow, long-drawn organic growth that we are planning. We are working in essentially the rural parts, underserved areas of the market. And when I said asset light model, we are getting this outsourced, we're getting the production outsourced and not using our own facilities to do this. And so we basically, depending on the monthly demand that we foresee, we get the outsourcing production done, which we then brand and distribute. That helps us to keep our asset allocation on this particular vertical fairly low, and allows us to grow at our own comfortable pace.
Also, what it helps us in is that since this is a new foray into our own branded TMT, till the time we wet our feet and we get a good sense of the business, we would rather not commit on capex and long-term capex. So we are going to use outsource. We understand the business, we understand the market, so we are using that, leveraging that to be able to create our own brand. Once we reach a critical mass, at that point in time, we will think whether we would want to invest in capex or not. So that's the strategy, and I think that's a very good strategy, because we are anyway having growth which we are going to get over the next 2-3 years, strong growth because of the expansion with the Tata Steel, businesses.
Understood. Thank you. And also, I would like to ask, in the beginning of the call, you had mentioned about 2,000 crore renewal. Can you explain that and the size and the opportunity? I didn't quite fully grasp that.
So this is a fair question. I think the contract that is going up for renewal is a CRM complex starting from April 2024 up to March 2029. It's a 5-year renewal. And on an annual basis, we expect anywhere between, let's say, 350 to 400 crores of annual revenue through this project. So on a 5-year basis, it extrapolates to 2,000 crores.
Got it. And if I may squeeze in one more, I'm being a little skeptical. Is there a chance that non-renewal of our contracts will ever happen in the future?
Theoretically, that's always a chance. I don't think I'm in a position to say that come hell or high water, there will be a renewal. As like any other contract, there is at the end of the day, I would like to believe that rationality prevails, and I don't see why not. I don't see why it won't be renewed.
And we've seen a long history, and as long as it's a win-win situation, I think it also tells us on one of the questions where they said that can you not increase the margin? That whole balance which we've been able to maintain with the quality probably is something which keeps
we set up this plant exclusively for the customer way back in 2013-14. We've already gone through the original contracting and then one renewal in 2019. And as like any other plant of this nature, which is a high capex, the first many years only goes towards paying the capex and paying back the initial cost. It's only in the latter part of the plant life that one really starts to kind of accrue money. As for my customer and for us, I think that time is now. So I don't see why the customer will not renew it, because there's economic sense in doing it for both of us.
Sure, sir. Thank you. And also, if I may, do you have any guidance for this year and for the medium term?
We'll have to be a little more patient on that. We'll be coming out with that, I think, with the next quarter.
With the next quarter call, we will be coming out with the first guidance. We are working on the long-term plan.
We are still kind of getting used to these calls, so you'll have to be a little more patient with us, please.
Okay, sir. No worries. Thank you so much. That's all from my side.
Thank you. The next question is from the line of Surya Narayan from Sunidhi Securities. Please go ahead.
Yes, sir, just to clarify one aspect, our profile and piping is below 1 foot dia, I believe, or let's say lower dia pipes. So is there any chance of going ahead when we approach for 1 million ton capacity, whether larger dia pipes is also under scheme of things?
So when we go for expansion and when we are talking to the customer, we will set up the plans depending on whatever size, profiles and range, etc., the customer would like to grow in. The size decisions are not ours. They are basically for the people who will market the product. So that's the customer. We only do the manufacturing support. So our manufacturing will be based on what the customer would like to sell.
Okay. And sir, just one question, last one, is that is a company like APL who is expanding and currently having 36 million tons of capacity, and whereas Tata's, I believe, have not entered into the pipes and they have looked into operating. So if that is the case, then will Tata plan to exceed at least to 30 lakhs tons of capacity? I mean, whatever, let's say, we are planning maybe 1 million ton. So it can be doubled more than that, going ahead. I mean, maybe we are among a few players who could be doing steel service centers. So what is because you are in the market, if you can give some sense of what the other players are present and whether the Tata's downstream, because Tata is currently focusing more on the downstream products. So in that case, whether more of the pipes will be coming into the markets from Tata.
So, like I mentioned earlier, I'm not qualified to comment on Tata's plans, but I'd like to believe that if they ask me to make the product, they intend to sell it. And so, if I increase my capacity and Tata sells, you will see more pipes in the market from Tata. In terms of other players in the sector, I don't think I can comment on that. I'm not very aware of what they are doing or what they are planning. There are several other people that manufacture pipes, and so I'm really not in a position to comment on what they plan to do or how much they plan to expand. I can comment on my plans and this company's plans. I think we've got a fair visibility for the next 2 years, which we shared.
Okay, sir. Thank you. Thank you.
Thank you so much, Suryanarayan.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you so much, everyone, for taking the time and being here. This is our first, so if I have goofed up somewhere, please do excuse me. And you can always reach out to Sanjeev ji and complain about me. He'll make sure that I fix myself going forward. Also, very happy and safe Diwali to all of you and your families. Hope to see you next quarter. Thank you so much.
Thank you. On behalf of BMW Industries, that concludes this conference. Thank you for joining us, and you may now disconnect.